In this set of video tutorials, we are going to learn about what are cash flow statements. Now, the first and foremost question should come in our mind is that these are statements beyond the income statement and the balance sheet. So why this cash flow statement or CF is actually required? I mean, the answer lies in the way we actually account for the income statement and the balance sheets. Now think about the income statement. How are the sales or COGS, cost of goods sold, and items in between till net income are kind of recorded? What kind of accounting principles do they follow? Are these cash receipts or are these cash expenditures? Obviously, we have discussed a lot about this. The answer is no. These are not cash expenditures or cash receipts. However, they follow something like a accrual method of accounting. And what do we understand by accrual method of accounting? Whenever a sales is technically due and it is earned, we record that sales. Even if the cash has not yet been received, we actually record that sales because we have technically earned that. Likewise, we use the matching principles to record our expenses. What happens essentially when we are doing these two things, accrual and matching principles, is that they do not reflect the cash positions. Now when we talk about the balance sheet just provides us with a snapshot of the assets and the liabilities. Essentially, if we want to simplify, what do we understand by balance sheets? It provides us with how we have accumulated our resources, and second, how we have funded those resources. So funding of those resources could be debt or equity likewise. Now if you look at balance sheet very closely, it does provide us with the cash that is available in the system. And when we look at the income statement, a company may be really doing good on the profit levels or the net income levels, but are these real cash? The answer is that this is not real cash, and a company may end up in bankruptcy if they do not have sufficient cash in the system in order to pay their liabilities. So if you look at accompanied with the income statement, it is very important for us to look at a statement called as cash flow statement, which provides us with the exact cash position of the company, how the cash has come in during the year, how the cash has gone out of the system, and what is the net cash position. For an analyst, cash flows can be really helpful. In fact, cash flows can help us in terms of understanding whether core business is generating enough from its operations. So whether they can sustain their own set of business or not for a long term can be gauged by the cash flow statements. And second, in fact, even more important could be that they do have enough cash to pay off their debt. So how will that come from? Whether they will require external source of funding to pay debt, or probably some other measure that needs to be deployed. So that can also be gauged from the cash flow statements. Third, it can also help us understand whether the company is in a position to meet something like unexpected obligations if they arise. Say for example, contingent liabilities. So in that case, whether they can meet or not can be gauged by the cash flow statements. Obviously, another thing would be if they have enough cash, they kind of look for new business opportunities. So this can also help us in terms of understanding whether the company can grow further by investing in new business if they have more cash. Let's talk about cash flows and its bifurcation in a bit more detail. Cash flows can be divided into three types. One is how that the company has achieved or received cash from its core operations of the business. So core operations would be cash collected from the customers or cash paid to the suppliers. The net effect could be classified as cash flow from operations. Now think about cash flow from investing as investment from the point of view of long term. Now from the point of view of long term, the first thing that may come in your mind would be something like fixed assets. So if you have bought fixed assets, classified as cash outflow, but this will be categorized into cash flow from investing. If you have sold your fixed assets, obviously that will again get categorized into cash flow from investing, but here there will be a cash inflow, here there will be a cash outflow. Now think about cash flow from financing. Anything which relies on the external sources of cash. We can talk about debt, or we can look at equity. Anything to do with debt or equity, raising of loan, repayment of loan, all of these could be classified as cash flow from financing. Raising of equity, issuance of equity, IPOs, all of these would be classified as cash flow from financing. So essentially you must understand that there can be inflows and there can be outflows associated with each of the categories. So an example of inflow here could be cash received from the customers, right? So cash received from customers. So this would be inflow to the cash. Now cash outflow could be something like cash paid to suppliers. This would be a cash outflow. Likewise, if you have bought fixed assets, cash outflow. Here, sold fixed assets, you will receive cash, that will be called as cash inflow. Likewise, raising of loan, so you have solicited money from banks, this would be a cash inflow. However, if you have paid or repaid the loan, that will be classified as cash outflow. So operating, investing and financing are kind of pretty intuitive here. Only difference being that when we talk about dividends, now dividends by default is because of equity holders, and when it is about equity holders, it should ideally get classified in anything with respect to dividends paid, that should classified as cash flow from financing. But whenever the dividends are received, now dividends can be received when you have made investments in certain securities, and those securities have paid some dividends. So dividends received are classified as cash flow from operations, CFO. But dividends paid is because of the shareholders, and hence it goes into the cash flow from financing.